Hello everyone, welcome back to another FinMeUp episode. We have Anthony Clark, also known as Smalltalkdaily, with us. He is one of the mentors and content creators on the FinMeUp app. I'm sure if you've followed him over the past couple of years, you've probably made some nice investments here and there. So it's great to have Anthony with us. We've interviewed him previously. You can check those videos if you're interested in those companies. Also, just a quick announcement, PetMeUp, FinMeUp's pet insurance product, is live. You can check the link in the description. If you have a dog or cat, please go check it out. Let us know what you think about it. Today, we'll be talking about 5 companies that I'm very interested in finding out about more. The one company I actually own in my personal holding, it's actually my second largest holding, and that is Argent. We're also going to be looking at Montauk, Afrimat, CMH, which is Car Motor Holdings, and Renergen, as usual. So the first company we're going to be looking at is Car Motor Holdings, CMH. Anthony, why did you choose this company? I know they are sitting on a massive dividend yield, extremely low valuations, and still they've got a good management team, if I'm not mistaken. So we'd love to find out more. Let us tell us more about CMH.
Yeah, hi Higgo. It's nice to be here, and hello to all the readers. I'm currently sitting in Romans Bay. It's raining outside, the fireplace is on, and the dog is fast asleep. And hopefully he'll wake up after I've talked about some of the stocks that I'll be discussing with you. CMH, or Combined Motor Holdings, to use its correct name, is a company that's been around since the early 1970s. In fact, the CEO, Jeb McIntosh, who's now probably 76 this year, he was the co-founder and he's still the CEO. And I don't think there's a CEO in the motor retailing and the car rental market which has more experience and has been through more cycles than Jeb McIntosh and his team. So what you're buying in CMH is a small company, market value 2 billion rand. It is owner managed, where the original founding owners still own about 45%. So they're skin in the game. And because they're nimble and they know the market so well, having gone through every cycle under the sun since 1970, since before you were born, not before since I was born, because I was born in 1967. They have a trusted, reliable management style, which is utterly conservative. They hate debt, they love cash, and they know how to run a very lean, mean business. In fact, if many other South African companies could emulate the formula that CMH has in terms of running a company for profit and on very low operating costs, this country would be a much better place to live in. So why CMH? The current share price is trading at 27.35 rand. It's fallen this week by around 2.50 rand. And don't be alarmed by that, because the company pays extremely large dividends. So the company had a February year end. Year on year, had a very nice bump up in earnings to about 6.17 rand from memory, a rise of around, call it about 15 to 20%. The price earnings ratio of a company, despite these good earnings and good dividends, is only 4.4 times. It is one of the cheapest stocks of quality that I actually have in the small cap universe. So some basic stats for you. Aside from very good earnings they released in the last 12 months, that is mainly derived from 3 main divisions. Combined Motor Holdings is a very large new car dealership, with the biggest brands being Ford, Nissan, Haval, Chery. They also own the Suzuki brand in this country, which is now the 3rd best-selling car after Toyota and Volkswagen. So in this very tough economy, if people are looking to buy new cars, they may not be able to afford to buy, the old quality vehicles of Volkswagen and Toyota for varying reasons, but they still want a very good quality car with all the bells and whistles and features, but at a slightly cheaper price. Suzuki has roared up the charts to become consistently the 3rd best-selling car in this country, and that is paying significant dividends for CMH. And unless the economy turns, fairly dramatically in the next couple of years, and people suddenly have more money in their pockets to go out and buy fancy BMWs, Mercedes, etc., Suzuki and the affordable brands inside CMH should continue to perform well compared to other motor retailers who tend to sell fancier, pricier cars. These days, with car repayments having risen quite sharply, we're all watching the rands and cents in our wallets and our purses. So that's one side of the business. The second side is they have the 3rd largest car rental agency in the country, called First Car Rental. Anybody that's flown Safair, as I'm sure many people do these days, given there are so few airlines, they have a link in with Safair, which means that they've picked up substantial business from that airline link. And given that inbound tourism has roared back since post-COVID, and we're not quite back to 2019 levels, but it's a law of supply and demand. As other car rental companies during COVID closed offices, sold cars, let staff go, CMH or First Car Rental trimmed back their fleet. And when the tourists suddenly started coming back after COVID, they were one of the few companies that actually had cars. And given supply and demand, if you wanted a car, you had to pay. And people did. Because as we all know, the rand in this country has gone to hell in a handcart. So if you're coming in from the United States, from Europe, from the UK, or from Asia, our rand is now so affordable, you can actually have a really good time. So you're not going to quibble about spending a few extra dollars, yen, or euros on a car rental. So First Car Rental had earnings in the period of 130% powering this division. And then lastly, we have a financial services business, which just does the likes of insurance, car repayments, and as an originator. So all in all, because it's conservatively run and run for cash, the company sits on 700 million rand of net cash for a company whose market value is 2 billion rand. If you strip out the cash, you can buy this company on a PE of about 3.3 times for a company that's been around for the best part of nearly 60 years and has a consistent profile. So the last dividend paid was 2.40 Rand. I'm a CMH shareholder, so the money hit my bank yesterday. So as you correctly said, the current yield on CMH is 14.9%. So you're buying a company which is family-owned, conservatively run, has net cash, is one of the best-run operators in its particular motor retailing segment, has a nice yield, but despite the fact the share price is only up 3% year to date, it is up 143% in the last 3 years, which is nearly double the growth of the JSE small cap index. So going forward, I don't see CMH having another fantastic year because the new and used car market, as we all know, is not exactly great. People do not want to buy new cars because of the economy and the tightness of their purses and their wallets. And the used car market is beginning to roll over as, again, affordability kicks in. But the tourism side versus First Car Rental should have another fantastic year. So I'm forecasting earnings to be down probably between 15 and 20% year on year. Now, don't get scared by that. Even if the earnings fall back to the number we had last year, which is 5 Rand a share, 5 Rand at a 27 Rand share price is still a P of just over 5 and a dividend yield of probably just around 10 to 11%. So it's one of these stocks where you get capital growth, consistency in the quality of management, and you get a very nice dividend yield. It's quite frankly one of the perfect trifectas for any private client portfolio looking to buy a little company, stick it away, and forget about it, because this is one of the few companies that you'll actually be able to sleep at night knowing that the CEO is a major shareholder and he's looking after his interests and as such looking after your interests. So that's combined motor holdings.
Very interesting. There's nothing like skin in the game to give an investor some extra confidence, and especially if the management team is on the conservative side of things. The next company is Montauk. I don't even know if I'm pronouncing that correctly. It's a company I saw the share price massive movements a few years back and never really got into it. But I saw when I look at the share price graph, 3-year basis almost, or 2-year basis is almost exactly where it was, but it had a massive spike in 2022. What is Montauk, and what do you like or dislike about the company?
Yeah, Montauk is a fantastic little company, but I will caution initially that you must do your own research. It's a simple but complex company to do with legislation in the United States regarding biogas, which is gas basically generated either from waste in landfill where methane is extracted, or the gas that is produced when you basically compost animal manure to extract biogas. Now, as we all know, the world is going cleaner and greener. And in the States, under the Democratic government, there's been a significant push towards reducing the dependence on fossil fuel and looking for alternative energy sources regarding renewable, biogas, and other forms of energy. Now, Montauk is actually a South African company. It was bought back over 15 years ago by an old investment company called Jonic, Johannesburg Consolidated Investments, which eventually HCI, Hoskins Consolidated Investments, bought in about 2009. And the company only really took off a few years ago as the environmental legislation in the states changed towards companies producing greener forms of energy. Then a subsidy was given to the companies operating in that area, and the gas produced from landfill and animal waste is either sold for the generation of electricity, so that you then get completely clean electricity, or the underlying renewable energy credits that you actually create by actually producing gas are also worth money. So in simplistic terms, they're producing a token which is actually worth money, even though they're producing gas as well. These tokens are tradable. So if you're an existing fossil fuel company producing, let's say, petroleum products or plastics or any form of natural fossil fuel-based products, you generally have to offset some of your carbon credits by buying some of these tokens to try and appear to be greener and cleaner, given the ESG movement we see internationally. Now, it all may sound quite complex, but if you understand the world is going cleaner and greener, and institutional shareholders are always banging the drum on ESG, then you would realize that Montauk is sitting in a very interesting place going forward regarding its development of green energy. The company's share price boomed in 2022 for one simple reason. When Russia invaded Ukraine, the international price of natural gas, which is the gas which is derived from fossil fuels, dug deep in the ground, soared. It went up from about $2 a million British thermal unit to nearly $8. It went up nearly 400%. And as such, these renewable energy companies and the tokens also boomed. As the natural gas market has unwound in the last few months, as the world has reduced its dependency on Russian gas, the natural gas price has come down. As such, the Montauk share price has come down, and to a certain regard, Renergen. Even though Renergen and Montauk are not gas companies in the traditional sense, they tend to move in line with a natural gas price, even though they produce liquid natural gas in Renergen's case and biogas in Montauk's case. So why am I looking at Montauk? One, it's a large company. It's dual listed on NASDAQ and on the JSE. Its market value is about, call it 15 billion rand, or just shy of $1 billion. The natural gas price in the States has started to tick up again, and the Montauk share price was 120 rand probably about a month ago, and it shot to 150 very quickly. I had a 2-page piece in the Financial Mail magazine at the end of May on Montauk, giving a detailed but quite understandable description about what this company is. So I'd urge everybody to have a look either at my website, I don't have a website, I take that back, at my Twitter page, Smalltalkdaily, or I've posted it as well on the FinMeUp app, and again, it's in the Financial Mail, to read what Montauk actually is. You'll understand what the company does quite succinctly. So it's a rand hedge, it's a play on the environmental credentials of the world, it's a play on ESG, and here's a really interesting little extra tidbit. The single largest shareholder is Johnny Copeland, who is the Chief Executive Officer of Hoskins Consolidated Investments, who unbundled this company in 2020. That stake to him is probably worth over 7 billion rand. There were rumors that he was looking to sell that company last year at his peak, because Montauk is one of only a couple of major biogas companies left listed in the States. Major oil companies have been buying these stocks to actually own the carbon credits themselves, to look good in the eyes of the US legislators. So the talk is that at some stage, Johnny Copeland, who's in his 70s, will cash in the chips, given he was initially in for 100 million rand, and that stake now is worth 7 billion, showing you how well Montauk has done over the last 10 years. So you've got the environmental credentials driving Montauk, you've got the natural gas price ticking back up, helping the price, and you possibly have a larger shareholder reaching a certain age where he may wish to estate plan, cash in his chips, and walk away. And it's a rand hedge. And in a volatile currency, I love rand hedges. So when the rand was at 1980, Montauk was at 150. We're now at about 1830. It's at 128.11. So it is volatile. It's a play of a rand, the US administration, ESG, and of course Johnny Copeland. Not for widows and orphans, but I've got some in my portfolio because I truly believe in the longer term. The way that the world is going, green ESG and environmental energy is going to be the way of the future, and you can't go against the tide. That's why I've chosen Montauk, and I own it myself.
Very interesting. I'm definitely going to have a deep look into this company. And let's stay on the gas side of things, which is Renergen. Before we go into Renergen, as Anthony said, if you want to look at that detailed view about Montauk, it is on the FinMeUp app. We also have various other mentors posting on the FinMeUp app. We also have a quiz. We have quite a few users who's got daily quiz streaks of over 100 days. That's something I haven't managed to do, so well done if you are one of those. Let us know what your quiz streak is in the comments. But let's stay on the gas theme. Renergen. So we all know about the Renergen, and they've provided many updates, and we've also interviewed the CEO quite a few times. So not what Renergen really does, but currently where they're at. So we know there's the potential US listing. There's a potential funding with a few CPs. What do you think of Renergen in this moment of time, and all the things they need to accomplish in order to really benefit and see the business reach its potential?
Yeah, I've written just a couple of pieces on Renergen in the last quarter, and people assume, and they often attack me on Twitter saying, well, why aren't you banging the drum on Renergen? And they say, well, it's not my job to bang the drum on Renergen. I'm not their spokesman. I only comment on legitimate news flow and give an opinion when a particular piece of information is pertinent to the public domain. So what has been going on in Renergen so far in the last quarter? The share price, as you know, hit a bottom about 2 months ago of 18 Rand 20. And everybody was screaming blue murder that the share price was going nowhere. But the patient, including myself, just sat and waited. Because as I wrote again in a Financial Mail article in March, which I think I also posted on FinMeUp, a 2-page detailed update as to the timeline as to what I expected from Renergen going all the way up to September this year. So far, that timeline has followed my crystal ball. And there's nothing inside Renergen that currently gives me cause for concern, because it's following exactly what I thought my crystal ball would actually deliver. So what did it deliver? Initially, it came out and said that the Development and Finance Corporation, the DFC, which is an American government funding organization, was looking at providing $500 million of funding to Renergen. It got through the initial hurdles, and a few weeks ago, the share price ran from 18 Rand 20 to 24 Rand. Now, 24 Rand is a very key level, because that was the last level when Renergen did a capital placement to raise money to fund its development going forward and the costs of a NASDAQ listing. From a 24 Rand, the share price just went one way, down. When the DFC news came up a few weeks ago, it ran back to 24 and promptly then fell back to about 19 Rand. And then when the second piece of DFC news came out, the official SENS, about a week and a half ago, the share price ran back up again to 24 Rand, and we're now back this morning down to 20 Rand 34. I've written, and it's become common knowledge amongst certain institutional investors, that there is a cabal of investors who are pretty dissatisfied with the underlying performance of Renergen. They've lost money at varying points by subscribing to the rights issues and the capital raises. And the only way they can make back their money is to go short of the stock and sell the stock at high levels, hoping to buy it back at lower levels, to be simplistic. Some analysis was done by myself and the company some weeks ago, and we ascertained from looking at varying script lending books that between 5 and 6 million shares in Renergen were at any point short in the market. Now that is quite important, because it equates to around 30 to 35% of the underlying free float, which means if any good news comes along in Renergen and the stock starts to run, the shorts, unless they want to get burned badly, have to buy the stock back, which then exacerbates what's called a short squeeze, which means they are compelled to buy back that stock to meet their obligations to the persons that lent them the company. So we've had 2 periods of the company being short, 2 periods of the company having a short squeeze, and we're now back to 20 Rand 34. Now, I would look at my crystal ball again, as I'm rubbing it here, which you can't see underneath my screen. And I would say, depending on when this podcast is going out into the open world, that the SENS announcement that came out from Renergen regarding the DFC approving the $500 million loan was contiguent or condition precedent, to use a legal term, on Congress approving the actual loan. The DFC every year goes through lots of applications. They go through an investment committee, an environmental committee, and then a board committee to approve the transactions that the DFC wants the US government to fund. It then goes to Congress, and Congress has 14 days to raise objections, to query any specific investment, and then they just rubber stamp them. I would suggest that given that Renergen SENS came out nearly 14 days ago, we are on the cusp of the Congress rubber stamping all of the applications for funding, including Renergen's $500 million, and then Standard Bank, which is also providing $250 million, will also jump on board, which means then that Renergen will have pretty much all the money it needs to fast-track much of the build of Virginia Phase 2, alongside the eventual NASDAQ listing, which should occur after Labor Day in September this year. So I would keep a very close watch out between now and whenever this podcast comes out to an update from Renergen to see if Congress has rubber stamped that loan application. I'm led to believe there has been no objections in the near 14-day process of adjudication, which gives me hope that this deal is coming through. If that deal comes through, I see the share price running again, because it always runs on good news. We need to break the 24 rand glass ceiling. If it does, I think the stock will run. So if we get the loan funding from Congress, what's the next steps? The next steps are quite logical. We all know the US market is riding high, the Dow Jones and the NASDAQ. We know the NASDAQ is being driven, albeit by the Magnificent Seven, like Meta, Apple, Nvidia, etc., etc. But the wider market is picking up. There was a very interesting IPO last week called Carver, which was it was heavily oversubscribed, and the share price doubled. So the IPO market, having been sleepy in the States, is beginning to perk up, which is good news for Renergen. So they'll be starting their roadshow and book build probably in about July, August. They'll then probably start the entire listing process in late August, September, to list, I would imagine, sometime in mid to late September. So we're now entering a period that if they get the funding from Congress, the roadshow wagon trail starts running. And that's where the next interesting piece could come from. Who will underwrite? Will any large shareholder wish to take a material stake? Which major global funds will suddenly take a stake in Renergen? Will it be oversubscribed? Will it open at a premium? Will it not work? So we're in for a period of interesting times. So to me, Renergen right now, 20 rand 34. It has always been a stock that has been volatile. It was never for widows and orphans, but it's one that I still believe in the long run will do extremely well. And to date, even though the project was late, if they get the DFC funding, that is a major, major milestone to the eventual production of Virginia Phase 2. And then we're off to the races, because this company will then start producing billions of rands of profit and paying us very generous dividends. So I'd say to you right now, Renergen, watch this space.
It's going to be very interesting to see how the market reacts if they get the approval, as well as how the US listing goes, and how the traction would be, and what the market reacts to in that aspect as well. It's never been a boring company. We've got two companies left, one of which I own personally. The first company we're going to look at now is Afrimat, and then we're going to look at Argent. So the reason why we're looking at Afrimat is they announced a deal yesterday, or it might be a few days ago for you that's watching now. But they announced an interesting deal. We all know that they've been amazing at allocating cash since the beginning. And if you look at the share price, it's just been on a steady growth trajectory for as long as I can remember. They are now sitting on a PE of 13. And I think just a lot of people are really backing the management in all the things that they do. But I know, Anthony, that you really follow Afrimat and you've been following them for long. What do you think of this new deal? And also, what do you think of their outlook?
Yeah, in context, I first picked up coverage of Afrimat in 2006 when they actually listed. And the share price didn't do that well. And at one point, you could have picked up a company for R2.15 back in 2008, 2009. And Bloomberg came out with a data point beginning of this year, but on a 10-year view, the best performing company in the JSE, it surprised many. It wasn't Naspers. It was actually Afrimat. Afrimat in a 10-year view was up 1,800%, and Naspers was only up 1,400%, showing you that if you pick the right small cap, which becomes the best mid cap over time, you can beat the largest companies on the JSE. So you're correct. Afrimat have been truly astonishing capital allocators, having covered every single deal that they have done from inception, ranging from 35 million rand to buy Glenn Douglas, all the way up to a deal of 2.1 billion, where they actually walked away in the end because the company wasn't exactly what they wanted. They have never put a foot wrong. So yesterday was a very interesting day. So yesterday was a Monday, was a Tuesday, June the 20th, for anyone listening to this podcast saying, what the hell is Clark talking about? The Investor Day gave a divisional breakdown of every single unit inside Afrimat, with a respective MD or CEO giving the prospects and the potential of a company. I always tweet that every Afrimat investor update always really reveals very good news, and the share price will run. I tweeted that on Monday the 19th. If anybody picked up that, they would have been up 12% on Tuesday, because the share price at one point was up 12.78%, as I detailed that all of their divisions, from Unkamati Coal to Jenkins Iron Ore to Demoneng to Construction Materials, were all doing exceptionally well. So the deal they announced yesterday was the acquisition of Lafarge Cement. Now, again, I'm old, so I remember when Lafarge used to be called Alpha Cement, and Alpha used to be called Blue Circle, and Blue Circle used to be owned by a British company called Blue Circle Cement way back in the day. And then it was sold, and then Blue Circle was basically bought by the Swiss company called Holcim, and Holcim is the world's single largest cement company based in Switzerland, even though it has a French-sounding name. So Lafarge is one of the smallest cement companies in this country. You've got the likes of Sopaku, Mamba, and PPC, and Lafarge produces 1.2 million tons of cement. So, but put all that aside, everybody was looking at this deal saying, why is Afrimat moving into cement? This deal was never about cement. If you understood the rationale and modus operandi of Afrimat, they want to get into areas where they have a natural competitive advantage, where their economies of scale can improve the underlying operating margin of a company, and where in many cases they can become the dominant supplier of a particular product in a particular sector. So inside Lafarge, putting aside cement, that's just a distraction. As I tweeted yesterday, Lafarge has a truly astonishing nationwide footprint of quarries, which will more than double the underlying size of Afrimat's own aggregates division. It'll make them the leading market share in aggregates in the country with nationwide representation. Now imagine the cost benefits and the cost synergies of being a national operator with a national distribution operation. The second part of his business is a little interesting mine called fly ash. Now people say, what the hell is fly ash? Now, without getting into any form of complexities, when you buy cement in a shop, you go to Builder's Warehouse, build it, or cash built. You are not buying the best of the best cement. You're buying household cement so you can build your extension, put down a patio, or build your garage driveway. If you're building a hospital, you need 42 grade cement. Most households take 31 or 32. The lower blend is called blended cement, which means normal cement produced by the likes of the PPC is blended with fly ash, ground up slag produced from the steel industry, and kaolin to basically extend it to make it cheaper. So it still works, but it's just cheaper. So it's a bit like buying, a product that has been watered down. It's still as good, but it's not as good as buying the real thing. But it's cheaper. So the real key to this Lafarge deal is the aggregates, the extenders, and the fact they have really, really strategically placed operations in Gauteng, which is the largest cement market in the country and the largest aggregate market. And the real sweet deal is they only paid $6 million for this business. Now that equates to about 110 million rand. The net asset value of this company is 1.4 billion. They do assume 900 million rand of debt, of which 500 million is repaid immediately, and 400 million is repaid in 12 months interest-free. But Lafarge also has 200 million rand of net cash inside the business. So I've given you a lot of numbers. But so on a net basis, Afrimat is basically paying 800 million rand for a company which is one of the best in the country with strategic assets, whose net asset value is 50% higher than what they're paying for it, and the replacement value of all the assets, should you buy them from new, would cost you 10 billion rand. This literally is one of the best deals that Afrimat has done in its entire history. And I would say that Andries van Heerden, without putting words into the CEO's mouth, would say that this is the best deal that the company has ever done and the deal of the century. So why is it interesting? On a 3.5 billion rand revenue, this company only makes 38 million rand in profit because it hasn't been very well run by the parent company who just wanted out of this country for whatever reasons, be it load shedding, be it the unions, be it lack of infrastructure spend by the government, who knows? They just wanted to get the hell out. And Afrimat bought it for a song. So if Afrimat can use its magic, which it's done on every single transaction, to get the underlying operating margins of Afrimat back to an 8 or 10% level, which is not unattainable for a company of this quality, Afrimat will be able to repay the total deal costs of Lafarge in 2.5 years. That's why this deal is so good. So from 2026, this starts to kick into earnings and once again gives consistency to the underlying solid earnings growth of Afrimat. And at 60 Rand, I have a target price of 80 to 85 Rand on this company, with really strong earnings kicking in 2024 from Jenkins Iron Ore and Unkomati Anthracite, 2025 from Glenover, which is phosphates, and now 2026 from Lafarge. So this country, to use an often used term, has a strong runway of earnings growth for at least the next 3 or 4 years. That's why Afrimat at 60 Rand, despite the run, looks great value for any long-term growth portfolio.
Very interesting. Just a quick question on that. I saw there was a few comments regarding this deal and concerns about the cement industry in South Africa, just because the economy is not looking too great and less people are building houses, expanding houses. So how do you think that will impact the entire cement industry? Because obviously this is part of the cement industry.
As I said to you, Lafarge produces 1.2 million tons a year. It has installed capacity of 2 million, so there is latency in the business. Afrimat said yesterday that total capex to get Lafarge up to a standard which it would be happy with would be 325 million rand over 3 years, which is hardly big change to an 8 billion rand market value business. So, as I said to you earlier, the real key deal to this are the underlying assets in aggregates, fly ash, and the operating plants in the grinding and blending plants. Even if they shut down cement and say, you know what, we don't want this, it makes hardly any money, we don't want to invest in it, it's just not what we want to do. It doesn't matter. The underlying deal more than pays for itself. The cement market is an interesting free option. If the cement market recovers in the next couple of years, and if Afrimat manages to get this business repositioned as one of the lowest cost blended cement suppliers, given I told you they are vertically integrated and actually produce many of the extenders that actually go into blended cement, they will be able to compete very, very aggressively against any other company. And as I put in a media comment yesterday, I would not want to be any other listed cement company knowing that Afrimat is going into the cement market. I would be shaking in my boots. They are extremely good operators. They run a lean, mean operation, and they have a proven track record of never putting a foot wrong, and as you correctly said, being the best capital allocators in the market. It would be a very brave and foolish man to bet against Afrimat, and even if cement goes badly wrong, they got it basically for free.
Very interesting. The final company we're going to look at is one that I own. It's my second largest holding as things are currently, and that is Argent. So the share price by the time of this recording is 15.80 Rand. It already had a nice run up after their trading statement. Once again, delivered a great trading statement. They are sitting on a PE of below 4, on a dividend yield of above 5%, and they haven't even announced a dividend for this year yet. The full results aren't out yet, but I won't be surprised if we see a dividend increase. They are buying back stock. They are actually also offshore in the UK. So there's lots of things going for them, and they've delivered year over year for the past 2 or 3 years. The management has really been effective in their execution. They are doubling down on what works, cutting out what doesn't work. So, that is why I like the company, but we are here to get Anthony's insights. He's been following this company for long. I'm sure you made a lot of money on this stock, Anthony. Argent, why is this one of your favorite companies, and what do you think of the outlook going forward over the next year or two?
Well, I'm going to be cheeky here. I'm going to throw a question back at you. Why did you buy it?
So, first of all, I love buybacks when it's at a cheap valuation. Second of all, over the past few years, they've really turned around the ship, focusing on businesses that are actually cash flow generative and getting rid of the businesses that aren't. Sitting on a nice dividend, so you are getting some return in dividends. The low PE ratio, so the valuation is quite good, and also specifically that they are in the UK market. And it's just for me a diversification, because most of my companies are tech-based. So, this is not something that I'm usually investing in, but it's good for diversification. So those are a few of my reasons being put on the spot. So what are yours?
Well, I'm glad you've been reading my research. So I'll give you a gold star for that. As you said, it's trading currently about at 15 Rand 80. The price earnings ratio is about 4.7. Year to date, the stock's only up 2%, but in 3 years, it's up 241%. Again, it's done 3 times better than the JSE small cap index. You are right. They had a trading update last week, which indicated that underlying earnings for the March 2023 period would be up between 11.3 and 31.3%. And the results, I think, are due out towards the end of June. On a midpoint PE of 4 Rand 11, given they earned 3 Rand 39 last year, that puts the stock at a PE of 3.9. And I've quickly worked out what my expectations for dividend are. They paid 45 cents at the interim. I think they'll pay 50 at the final, which puts the stock at a dividend yield of 6.6% and a price earnings ratio after results of 3.9. And what you probably won't know, because it's hidden away in the accounts, is they sit on 300 million Rand of cash in hard currency, in dollars, euros, and pounds sterling, which means they get translation benefits. So if you strip the cash out of Argent, you're probably buying the stock on a PE of under 3 for a company which still has legs to grow at least 20% year on year. And with the Rand having gone to hell, particularly after its March year end, because the Rand blow off against the pound and the dollar only really happened in April, it's going to have a really, really good solid first half. And the underlying order books inside Argent are quite juicy. They're sitting currently at around 500 million Rand of forward order books in their offshore units. So why do I like the company? Well, I have to go back slightly in history. I've covered the stock for the best part of 20 years. And for listeners who don't know the stock, Argent back in the late 90s was one of the go-go stocks in the industrial market. It reached a peak of nearly 20 Rand. And then from 20 Rand, it crashed all the way down to less than 3 Rand in 2018. The answer to that was incredibly simple. The CEO, called Treve Henry, who I've known for many, many years, can be called an entrepreneur, and he can also be called colorful, which means he runs the business as he sees fit. Now, when you're dealing with a professional institutional market, they don't want colorful entrepreneurs running companies who are doing their own thing. They want the traditional mold of a CA who wears a suit and sits in an office and does what he or she is told. Argent didn't do that. They went on a wild acquisition spree. They were buying everything under the sun. They didn't pay dividends, and they were racking up large amounts of debt. That then led to an earnings destruction, no dividends, and the share price followed earnings, and it just crashed. So then why did I have a buy in the stock in March 2019 at 3 Rand 52? The answer is simple, because it's my job to actually track companies. So I flew down to Umhlanga to spend the entire day with the company, kick the tires, for anyone who realizes why I go out to see companies to kick tires, because you can only understand a company when you actually go and see them and see what they do. It was clearly evident that a new offshore shareholder who owned 30% of the company was directing the CEO to clean up his act, sell low margin, working capital intensive businesses to focus on higher margin offshore businesses, to sell excess property, because Argent owned all its own buildings in this country, some of them in less than salubrious, or shall I say, some in really crappy parts of the country, and they sold them. All the money they then used to do a share buyback, As you correctly said, they've bought back nearly 40% of their shares in the last few years, and they sent money offshore to buy niche businesses in the UK involved in fire safety, roller shutter doors, garden fences, shopping trolleys for Amazon, tankers to move fuel around the airport, amongst other things. All niche businesses which either tend to be heavily regulated or tend to be, they are the sole supplier. So I'll give you one example. During COVID, they bought a company called Fuel Transfer, which had the exclusive right to actually move fuel for aircraft around some airports in the UK and at military establishments. Now you say, well, that's not exactly a great business. But in the UK, if anybody knows, everything is regulated. Health and safety rules everybody's lives. There's a law for everything, which means that you have to be a certified supplier and have a long-term track record to actually run a company moving fuel around a very strategic area like an airport or a military base. This company, Fuel Transfer, because of COVID, nobody was flying, went bust. Argent Industrial bought that company for the grand sum of £1. Call it 20 Rand. They took on intercompany debt, and as it stands this year, that company will probably make £5 million in profit, showing you that if you buy the right company at the right time and just wait for the cycle to turn, you can make good money. The same is true with a company called Partington in the UK. Now you think, why would we want to buy a company called Partington, which makes collection trolleys for large warehouses? What happened during COVID? Everybody went online shopping, which means these enormous warehouses needed to pick and pack. What did you pick and pack into? Trolleys. So they bought Partington for next to nothing and became one of the leading trolley makers in the UK. And we all know that online shopping continues to boom with Amazon and the like, particularly in the UK. So they tend to buy small niche companies which need minimal capital, and they just invest in them, and the rest is history. So now Argent Industrial, 30% of its revenue comes from offshore, with over 50% of its profit. They are continuing to sell domestic assets to recycle the money into offshore interests. And that's where the kicker to this company comes from. One, they bought back shares. That aids in the underlying growth in headline earnings per share. Two, they are debt-free. Three, they are selling assets locally to recycle into offshore assets where they earn a hard currency return, and they have usually a niche market. Four, the UK assets they bought have been bought at cheap prices and are doing quite well. And fifthly, they just keep on doing exactly the same. It would not surprise me in due course that Argent Industrial perhaps decides to delist from the JSE and reverse itself potentially into a listing on the London market. Because I guarantee you, on a JSE listing of under 4, if you were to relist this business, which has been profitable now for the last 19, 20, 21, 22, 23, for the last 5 consecutive years or 10 reporting periods, you will not be on a price earnings ratio of under 4 and a dividend yield of 6%. So I can see the share price, in theory, if a listing were to occur in London, more than doubling. So I'm not saying it's going to happen, but the potential is there. And I think at some point, as we all know, if companies get cutful of being listed on the JSE because of rubbish ratings, they will say, that's it, we're leaving and we're going elsewhere. And Argent, I think, is getting near to that point of saying, screw this, we're leaving. I'm not saying going to do it anytime soon, but it's a thought in the back of my mind. And if I'm thinking this, companies think this. So at 15 Rand 85, despite the fact that Argent has had a very good run in the last few weeks, it was 14 Rand 20 a fortnight ago. I have a target price minimum of 18 Rand, and I could easily move at 20 Rand on my earnings expectations of 5 Rand to March 2024. So as I quickly work out on my little calculator right now, if I put in 5 Rand at 15.85, the PE next year falls to 3.2. Now you name me a company which would have had 11 consecutive years of compound growth and dividends or share buybacks with potential, with growing Rand hedge qualities, given what's going on with the Rand in this country, trading on a PE of 3.2. I dare you to find one, which is why Argent to me will be a consistent hold in any long-term growth portfolio. It's small, it's somewhat illiquid, but it's a quality stock for any long-term growth small cap portfolio. I own it myself. I have done for years, and I'm not selling it.
As do I. And it's going to be interesting to see how their full results are when that comes out. And also if they're going to do more acquisitions over the next year or two. It's going to be interesting to watch. Thanks for watching. I hope you got lots of insights. Like if you got some insights, we really appreciate it. And subscribe if you want more content like this. We'll also be covering the results that come out on the weekly stock, which where we just share the most important stock market news that happened during the week with extra insights and opinions. And finally, remember PetMeUp, our pet insurance product is live. You can get more info in the link in the description and also check it out if you have a dog or cat. Hope you have a great day. Thanks for watching. Thanks, Anthony. Cheers.
Take care.